Measured, 70% of your wealth sits in one address. Your house is worth $900,000. The mortgage is down to $200,000, and the remaining $700,000 is equity. Add $300,000 of investments, cash, and other net assets, and your net worth reaches $1 million. Nothing is automatically broken. You have real wealth, valuable shelter, and possibly a mortgage rate worth protecting. The contradiction is that $700,000 of equity is not interchangeable with $700,000 in a brokerage account. If you need $50,000, the house cannot produce it while remaining unchanged. You either sell, borrow against it, or take the money from the $300,000 outside the house. That one expense consumes roughly 1/6 of everything on the liquid side. So the immediate answer is not that 70% creates a crisis. It means more of your future decisions depend on a single indivisible asset cooperating with your timing. And honestly, getting here does not require reckless behavior. You bought the home years ago. Every mortgage payment reduced the debt a little. The property appreciated. Meanwhile, retirement contributions competed with college costs, healthcare, repairs, and normal life. The house kept growing automatically, while the financial portfolio grew only when you actively funded it. Pew Research Center's analysis of 2021 household data found that home equity represented a median 45% of homeowner net worth. The median was 63% for Black homeowners and 66% for Hispanic homeowners. 70% is extreme, but it is not some imaginary balance sheet created by a real estate fanatic. Ordinary paydown, appreciation, and slower saving elsewhere can take you there. That also explains why the concentration often feels responsible. You did what the culture rewards. You paid the mortgage, maintained the property, and watched your debt fall. Every piece looked prudent on its own. The allocation drifted because nobody sends you a warning when your roof becomes your largest asset class. The correct calculation starts by separating four numbers that people casually blend together. The property value is $900,000. That is the estimated price of the whole asset. The mortgage is $200,000. That is the lender's claim. Home equity is $700,000. That is the property value minus the debt. Your net worth is $1 million because you add the equity to the $300,000 elsewhere. This is not your loan-to-value ratio, and it is not the national percentage of housing value collectively owned by households. The concentration number is your home equity divided by your household net worth. Trapped does not mean fake. The equity is real. It means the money has conditions attached. Access normally requires a transaction, debt, or relocation. The house also provides shelter, stability, control, and emotional utility. Those benefits matter. They still do not make an appraisal spendable. Now, put the balance sheet through a geographic stress test. Your $700,000 depends on one local property market. If your income also comes from the same region, your largest asset and your earning power may be exposed to the same local economy. Historical research from the Federal Reserve Bank of Richmond examined the housing collapse from 2006 through 2009. In the county studied, a housing shock that reduced housing wealth by 10% was associated with an employment decline of about 4.4% by 2018. That is evidence from a severe historical episode, not a forecast that your county is about to repeat it. The useful lesson is the correlation. A weak local economy can damage buyer demand. At the same time, it damages your employment options. The asset you plan to sell may become harder to sell precisely when moving for work becomes more valuable. Stocks can fall while you keep living in the house. A house can fall while influencing where you live, where you work, and what moving costs. Geography turns a price change into an operational problem. The obvious defense is to move and redeploy part of the equity. Then the low mortgage rate enters the room. National Mortgage Database figures for the first quarter of 2026 showed that about 49.9% of outstanding mortgages still carried rates of 4% or lower. At the end of July, Freddie Mac's average for a new 30-year fixed mortgage was 6.66%. On an illustrative $200,000 30-year loan, principal and interest at 3% are about $843 a month. At 6.66%, they are about $1,285. Same debt. Roughly $440 more every month before taxes, insurance, or any difference in the replacement property. Your actual old payment depends on the original balance and remaining term. But the mechanism is clear. A favorable mortgage lowers the cost of staying while raising the relative cost of leaving. A federal housing finance agency study estimated that every percentage point by which market rates exceeded a homeowner's origination rate reduced the probability of selling by about 18.1%. The low rate is a genuine financial asset. It is also a lock on the door you would use to rebalance. By the way, if this kind of boring balance sheet math is useful, subscribing to Lazy Investor helps a lot. I appreciate everyone who does. Even if you accept the new rate, the exit has a toll. Total selling friction is not one universal commission. Broker compensation is negotiable, and the practice changes that took effect in August of 2024 prohibited offers of buyer agent compensation from being displayed through participating multiple listing services. Buyers generally sign written agreements with their agents, and compensation can be negotiated through several structures. That did not eliminate title charges, transfer taxes where applicable, repairs, preparation, concessions, moving costs, or brokerage fees. A practical planning range for total selling friction is often around 6 to 10%, although the actual number can fall outside that range. On a $900,000 sale, 6% is $54,000. 10% is $90,000. Pay off the $200,000 mortgage, and your $700,000 equity statement may produce roughly $610,000 to $646,000 before any taxable gain, replacement home closing costs, or renovations after the move. Slows down. This was never mainly a question about whether the house earned a good return. It is a question about who controls the timing. Concentrated housing wealth has to pass 3 tests. Can it produce cash without creating new debt? Can it change geography without paying a large toll? Can it be divided or transferred without forcing a transaction? Your $700,000 struggles with all 3. The 30-cent side of the balance sheet now has to protect every exit the 70-cent side cannot provide. A divorce makes that visible immediately. Suppose the home is marital property and, for illustration, the equity claim is divided equally. The details vary across community property and equitable distribution states, and separate property can be treated differently. But an equal split would create a $350,000 claim for each spouse. One spouse wants to stay, the other wants cash. You have only $300,000 outside the house. Paying a $350,000 buyout from financial assets would consume the entire liquid side and still leave a $50,000 gap. Trading retirement assets to the departing spouse can solve the ownership question while damaging the remaining spouse's retirement liquidity. Refinancing can fund the buyout, but now the low mortgage may disappear and the home carries more debt. Research on homeowner divorces finds that transferring the home to one partner and selling it are both major outcomes. That makes sense. A transfer preserves the property only when the staying spouse can fund the settlement and satisfy the lender. When that arithmetic fails, the sale becomes less voluntary. The house did not cause the divorce. Concentration determines how many financially tolerable ways the property can be divided after it. Inheritance creates the same mechanical problem with more signatures. Assume the $700,000 of equity passes to 3 adult children. Each heir may have a theoretical interest worth about $233,000. They did not receive 3 separate assets. They received claims on 1 kitchen, 1 roof, and 1 property tax bill. 1 heir wants to live there, 1 wants cash. The third thinks the market will improve next year. Insurance, taxes, utilities, maintenance, and the existing mortgage continue while they decide. Probate can delay control when the property is not structured to pass outside the estate. A trust or a transfer on death deed may avoid parts of that process when properly designed, but availability and suitability vary by state. They can improve the transfer plumbing, They cannot guarantee that several beneficiaries will agree on what to do after ownership changes. If co-owners cannot agree, a partition action may eventually force division or sale. States that have adopted the Uniform Partition of Heirs Property Act provide added appraisal, buyout, and sale protections in qualifying cases. That reduces some abuse. It does not turn one house into several liquid inheritances. Leaving the house to your children transfers the wealth. Without planning, it can also transfer the concentration and the coordination problem. Then comes the deadline that arrives every month: retirement spending. Your home may reduce the amount of income you need, especially if the mortgage is small or paid off. That is an enormous benefit. Shelter and withdrawal capacity, however, perform different jobs. If someone looks at your $1 million net worth and casually applies a 4% withdrawal figure, the result appears to be $40,000 a year. But you cannot withdraw 4% of the full million while continuing to live in the same house indefinitely. Apply the same arithmetic only to the $300,000 outside the property, and the result is $12,000 a year, or $1,000 a month. That is before tax and before adjusting for market conditions. It is not a personalized spending recommendation. It demonstrates how dramatically the answer changes when spendable assets are separated from shelter wealth. Vanguard's 2026 report showed a median defined contribution account balance of $107,269 among its participants aged 55 through 64. That is Vanguard participant data, not a measurement of every retirement asset held by every American. It still shows how a household can reach late career with a meaningful balance sheet total and a much thinner financial portfolio than the home value suggests. The house can reduce rent or mortgage expense. It can provide stability. It can serve as a future relocation resource or legacy. What it cannot do is pay for groceries, healthcare, travel, or income taxes from an appraisal. This is where conventional retirement snapshots often become misleading. They place home equity and financial assets inside one reassuring net worth box. Actual withdrawal systems operate on cash, bonds, stocks, and other assets that can be sold in pieces. Your roof cannot be liquidated one shingle at a time. You can tap the equity, but each method exchanges one constraint for another. A home equity line of credit creates accessible cash by creating secured debt. Most HELOCs have variable rates, so the payment can change. When the draw period ends, payments may rise materially as repayment begins. A lender can also reduce or freeze access under certain conditions. The line is useful when the need, duration, and repayment source are controlled. It is not income, and it is not diversification. For eligible older homeowners, an FHA-insured home equity conversion mortgage can provide another route. Eligibility generally begins at age 62. The available proceeds depend on age, rates, property value, existing debt, and program limits. You receive only part of the equity, and interest plus fees accumulate against the home. You must still occupy the property as required, maintain it, and keep property taxes and insurance current. The loan generally becomes due when the last eligible borrower no longer lives there. A reverse mortgage can solve a real cash flow problem for the right household. It does not transform $700,000 of equity into a free $700,000 retirement account. So selling is expensive, borrowing is priced, and doing nothing leaves the concentration in place. That sounds like a dead end, only if you assume rebalancing has to begin with the house. It usually does not. I think of the response as the lazy rebalance ladder, ordered from least disruptive to most invasive. The first move is accurate accounting. Then track which future obligations can be paid from the second column without debt or a forced sale. That calculation tells you whether 70% is merely concentrated or already fragile. A household with reliable income, strong insurance, low spending, clear estate documents, and enough liquid reserves has more optionality than a household with the same net worth and several approaching cash demands. The least invasive financial action is to stop feeding the concentrated side automatically. Extra principal payments can feel productive because the mortgage balance falls on schedule. If the outside portfolio is underweight, sending every spare dollar into the house may improve the debt number while weakening access to cash. Redirecting suitable new savings, bonuses, inheritances, and other windfalls toward diversified financial assets can reduce the ratio without touching the property. If the home value stays at $900,000, while the outside assets grow from $300,000 to $500,000, home equity falls from 70% of net worth to roughly 58%, assuming the mortgage and other items remain unchanged. No moving truck, no commission, no new variable rate debt. You restore options with the next dollar, rather than demanding that the previous $700,000 become liquid overnight. A quick thank you to everyone who subscribes. It genuinely helps Lazy Investor keep doing this kind of housing math, and I'm grateful for it. A favorable fixed mortgage can remain in place during that process. Treat it as cheap housing finance, not as cash you can spend. Those are different benefits. Preserving the rate may be rational even while you deliberately build assets elsewhere. Estate planning comes next because it changes control without changing where you live. A qualified local attorney can evaluate whether your title, will, trust, beneficiary structure, or transfer on death option matches the outcome you intend. The purpose is not to produce more paperwork. It is to reduce the chance that death turns one concentrated asset into a prolonged negotiation among heirs. The property itself moves higher on the invasiveness ladder when life already creates a natural decision point. Retirement and necessary relocation, accessibility needs, an empty nest, or a major maintenance cycle can make reassessment worthwhile. If you are moving anyway, calculate the net sale proceeds rather than staring at the $900,000 listing price. Request seller net estimates at several plausible prices. Negotiate compensation. Include preparation, taxes where applicable, concessions, moving expenses, and the cost of buying or renting the next home. Then decide how much of the released equity belongs in the replacement property. Rolling every available dollar into the next address preserves the concentration under a different roof. A less expensive home may release capital, but only after selling costs, purchase costs, renovations, taxes, insurance, and any homeowner association fees are counted. Renting after a sale is more invasive emotionally for some people, yet it can create the largest increase in liquidity and geographic flexibility. It also reintroduces rent increases, lease risk, and less control over the property. That is not automatically better. It solves a different problem. A HELOC belongs above a natural rebalance because it introduces a payment and rate exposure while leaving the geographic concentration unchanged. It can work as a temporary bridge with a defined repayment source. Using it to fund an open-ended retirement shortfall is much harder to defend. A reverse mortgage sits in a different category. It may fit an older homeowner who strongly prefers to remain in the property, has limited liquid income, can meet the continuing ownership obligations, and understands the effect on future equity. The costs and growing loan balance by the ability to stay while accessing part of the house, that can be rational. It is still a priced trade. The most dangerous response is blindly extracting equity to buy investments because the portfolio feels too small. You have not diversified the property. You still own the same house in the same local market. You have added leverage, a payment obligation, and possibly a variable rate. Then place the borrowed money into assets that can decline. If the portfolio falls while the local housing market weakens or your income changes, both sides of the strategy can demand patience at the same time. Leverage does not restore optionality when the debt itself removes options. The threshold for disturbing the house should therefore be higher than the threshold for redirecting new money. A property transaction makes sense when the quantified improvement in liquidity, spending capacity, geography, or lifestyle exceeds the lost mortgage value and the full transaction toll. Borrowing makes sense only when the purpose, cost, duration, and repayment source remain acceptable under a realistic stress test. Calmly. The house is either a wealth decision or a lifestyle decision. Pretending it's both is how the math breaks. Calculate the concentration, protect the assets outside the property, direct the next dollar toward the underweight side. Repair the estate documents before several people need to cooperate, and reconsider the house when life creates a natural decision point rather than manufacturing a crisis. 70% in one address does not mean the house owns you. It means your plan is unfinished until your important decisions no longer depend on that address opening on demand. It means your plan is unfinished until your important decisions no longer depend on that address opening on demand.